Welcome to the lesson. We're going to answer April 2024 Advanced Financial Management paper. Question 2A reads, two assets, A and B, are known to lie on the security market line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. You are considering the following securities which are available in the market. You have security A, B, C, D, E with expected returns and betas provided. Required, determine the risk-free rate of return. Determine the risk-free rate of return. That is Roman 1. Determine the risk-free rate return. Now, candidates, in the context of this question, you can see we have asset A has a beta of 0.5 and a risk-free rate of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. Now, before we get the risk-free rate, what is beta? What is the meaning of beta? Beta. Now, beta measures the sensitivity of an asset's returns to the overall market's returns. That is to say that beta indicates how much an asset's price is expected to move in relation to the market movements. And by now I know you know that beta of 1 indicates that the price is moving in tandem with the market. That is beta that is equal to 1. Because remember, I've just said that beta measures the sensitivity of an asset's returns to the overall market. So if you have a beta of 1, that means that the asset's price is moving in tandem. It is moving at the same rate with the market. But you may have beta being greater than 1, like is the case here with the asset B. Asset B's beta is 1.75. So this 1.75 is greater than 1. What does that mean? Now, when you have an asset beta that is greater than 1, that tells you that the asset is more volatile than the market and its price will move more than the market. The price will move more than the market. That tells you that that price is more volatile if it is greater than 1. You may also have an asset beta that is less than 1, like the one in asset A. Asset A has a beta of 0.5. 0.5 is less than 1. Now, this asset is less volatile than the market. That is to mean that for every 1% change in the market, asset A's return is expected to change by 0.5%. Is expected to change by 0.5%. And we've seen that asset B's beta is 1.75. Is 1.75, which is greater than 1. Asset B, I indicated, is more volatile than the market, meaning that for every 1% change in the market, asset B's return is expected to change by 1.75%. But we also read that these two assets lie on the same security line market. The two assets A and B are known to lie on the security market line. They both lie on the security market line. So what is a security market line? Now, a security market line is a graphical representation of the CAPM, which helps investors understand the relationship between risk and return for different assets. So asset A and B, all right, two assets A and B lie on the security market line. What does that mean? Now, since both assets lie on the security market line, their expected returns are directly proportional to their betas. That is what it entails. They are directly proportional to their betas. It is important for you to have that small knowledge, beta, because we have a column there for beta. Now let's now work out the risk-free rate of return. The risk-free rate of return. I'll begin on page 1. This is April 2024, question 2A, Roman 1. We are to calculate the risk-free rate of return. The risk-free rate of return given the information. In the first sentence, we have asset B has an expected rate of return of 20% and a beta of 1.75. Then in the same question, the expected rate of return is 20%. Expected rate of return is 20% and the beta is 1.75. So, how do we determine the risk-free rate? Which formula are we going to use? We are going to use the CAPM formula. Expected rate of return is equal to risk-free rate plus the premium. The premium is RM minus RF times beta. And we are going to use the beta for asset B because that is the information we have. Asset B, we have the beta of 1.75. The expected return is 20%. We do not know the risk-free rate. How about the risk-free rate? We do not have it, but we have the beta of 1.75. 1.75 is the beta. Okay. Then what other information do we have? Asset A has a beta of 0.5 and a risk premium. So we have the risk premium. Return on the market minus risk-free, that is the risk premium. So we have the risk premium of 4%. That clear? The risk premium, we have it. And therefore, this should be equal to, this is equal to. So you see, risk-free rate is the unknown, and we are going to calculate it. This is 20% risk-free rate plus 4% times 1.75. How much is it? Kevin says 7%. Is it 7%? 7%. 4% times 1.75. Is it 7%? Muhammad Hassan says 0.07. Convert it into percentage. That will be 7%. So you can see here, candidates' risk-free rate will be 13%. It's 20% minus 7%. 13%. Is that true? 13% is the risk-free rate. Kabasha, welcome. Then we are required to calculate the required rate of return. The required rate of return. There was a problem with the setting of the question here because that Roman 1 ought to have been part of what we have answered. Before you come to, you are considering the following securities which are available in the market. Roman 1, we are to calculate the risk-free rate. Roman 2 is independent of Roman 1. Roman 1, we were to determine the risk-free rate given the data before the table, the data before the securities shown in the table. Two securities A and B are known to lie on the security market line, are known to lie on the market security line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.7. The risk-free rate that we have computed in Roman 1, we're going to use it in determining the required rate of each security in Roman 2. Okay, so we need to make that correction in the question. The question was misplaced. Roman 1 was required to be inserted before the table. In Roman 2, we are to calculate the required rate of return. The required rate of return. Roman 2, required rate of the required rate of return. Now, the required rate of return, we still use CAPM to calculate the required rate of return, which is equal to risk-free rate plus market return minus risk-free rate times the beta. And we'll calculate for each security. We have a column for the security A, B, C, D, and E. And now the E. Okay, so that's the first column. Then, are we together? Hannah, we are answering April 2024. So for security A, the risk-free rate is 13%, and that will be constant for all the securities. 13%. We add the premium. Market return minus risk-free is the premium. The premium is also 4% for all the securities. Then we multiply by the beta for security A. The beta for security A is 2. That will give us the required rate of return. How much is it? For B, it will be 13 plus 4 times the beta of 0.75. C, 13% plus 4. The beta there is 1.25. D, 13% plus 4, beta negative 0.25. E, 13% plus 4, the beta there is 3.25. So these are the required rate of returns for each security. So can I have the answers? Kevin says 21. It's 21%. These are percentages. B, 16%. 16%. Security C, is it 18? Kevin says 18%. Security D, Kevin says 12%. The last security, 26. Required rate of return, 26. So that's it. How many marks? How many marks? 4 marks. 4 marks. That's 4 marks. 1, 2, 3, 4, 5. 4 marks. This was how many marks? 2 marks. 1, 2, 2 marks. Now let's answer the second part. This second or third. Identify which security is undervalued, overvalued, or correctly valued. Now to calculate or to determine or identify which security is undervalued, overvalued, or correctly valued, we are going to compare the required rate of return and the expected return. So we're going to have another table for, this is 3. We have a table for security A, B, C, D, E. Then from the information given, we have expected return. You have a column for expected return. A, 20%, B, 14%, C 15%, D 12%, E 31%. This you are going to compare with the required rate of return. Required return that we've got determined here is 21, 16, 18, 12, and 26. So to determine whether a security is overvalued, undervalued, or correctly valued, we compare the required return against the expected return. Now someone tell me, is security A overvalued, undervalued, or correctly valued? Roger says undervalued, undervalued, undervalued. Roger says undervalued. Any other attempt? Anna says overvalued. It is above the expected. So it is overvalued, correct? Overvalued. Security A is overvalued. Now, candidates, you need to understand that expected return is the return an investor anticipates earning from a security. And required rate of return is the minimum return an investor expects to compensate for the risk of investing in the security. So when the expected return is higher, let me begin with that. When the expected return is higher than the required rate of return, it means the security is potentially offering more return than investors demand for its level of risk. And that suggests the security is undervalued. And it might be a good investment opportunity. But in this case, in the first case, the expected, in our case here, the expected return is lower. This expected return is lower than the required rate of return. That indicates that the security is not meeting investor expectations for its level of risk. It is therefore considered overvalued. And investors might be less inclined to invest in it unless the price drops. So security A is overvalued. Now with that knowledge, what do you think of security B? Is it overvalued or undervalued, security B? If security A is overvalued, what of security B? I've seen many candidates confusing. That's why I'm taking time to explain, so that you don't just memorize, but you should have the understanding. Why is it overvalued? I've explained why it is overvalued and the implication of overvaluing it. B is overvalued. That is what Jackie says. Overvalued. Jackie says overvalued. That is correct. Security C. Overvalued. Security D. B is overvalued. D. 12. This one is correctly valued. Correctly valued. Correctly valued. Then the last one is definitely undervalued. Undervalued. It is undervalued. So that would earn you just 2 marks. 2 marks. 1, 2, 3, 4, 5. 2 marks.